It is nice to be here. I personally have never been here before. And it's great that you are starting your sessions today with a session on history. I've always been a little bit surprised that economists, for the most part, seem so allergic to history. I know when I was in graduate school, the course on history of economic thought was the least popular among the courses, and the serious economic students, of which I was not one, tended to look down their nose at those of us who took it and found it interesting. So I think if you look at what's happened over the last few years, you have to think maybe a little more attention to history would have been a good thing. A few more people reading Kindleberger, and we might not have gone through quite the bumpy road that we went through. So I'm delighted to have the opportunity to moderate this session, and where I think we are going to look in particular at whether the quarter century that followed the historic events that took place at this hotel may hold some lessons that can help us navigate the new era that we are clearly entering now. Very distinguished panel to discuss this. Robert Skidelsky, who is the Professor Emeritus of Political Economy at the University of Warwick. Leanne Usher, who is an Assistant Professor of Economics at City University of New York, and Barry Eichengreen, who is Professor of Economics and Political Science at the University of California at Berkeley. Each panelist is going to have about 15 minutes to present their ideas. We will have a discussion among us, and then we'll open it up to questions from all of you. And Robert Skidelsky will start.
Alan, thank you very much for that. I do agree very much with what you say about history. I think both sorts of history, the history of economic thought and economic history, should be studied and would both throw light on very important matters of concern, because I think I think that the great economists of the past have very valuable things to tell us, and they're not obsolete. Their death does not render them superfluous to requirements. Even though Keynes said in the long run we're all dead, I don't think that applies to economists. Their ideas can live. Now, I think in international, when one's thinking of international monetary relations, the phrase plus ça change, plus c'est la même chose simply runs through one's head. The problems seem to be recurring, whatever system is adopted or combination of systems. And the basic issue is who adjusts to who. The creditor to the debtor, or the debtor to the creditor, and by what mechanisms. Reform always seems to be urgent, but it never really happens except when there's a terrific crisis. I think the reform is urgent today, because although the recent financial collapse had many causes, the reserve accumulation by a group of East Asian countries was, I think, one of the most important ones. And unless one finds some way of getting to a more symmetrical system, in other words, solving the adjustment problem, because at the moment there's no adjustment mechanism, one is going to just walk into the next crisis. Now, I want to say one word, although we're going to talk mainly about Bretton Woods and what was accomplished here and then, and leading on from that. I want to say one word about the international gold standard, because the system basically that finally collapsed in 1931, because under the gold standard, it was supposed to be, the delusion was it was an automatic standard, that you didn't require any international coordination. You didn't actually require any policies, except the single one of maintaining the value of your currency in terms of gold. And provided you did that, everything else was supposed to follow automatically. It never worked like that. It didn't work like that before the First World War, and it worked like that even less after the First World War, because prices were never flexible enough and couldn't be flexible enough to make a system, an automatic system, work. And the creditor was always, both creditors and debtors were trying to protect themselves in one way or another from the pains of adjustment. And when a system like that did work, when the gold standard worked, a lot of people have argued subsequently that it worked because there was a hegemonic power that made it work. Before 1914, this was really the City of London. And after, in the Bretton Woods system, it came to be the United States. And one of the reasons for given for the collapse of the system in the interwar years was that the old hegemon could no longer do the job, and there was the new hegemon wasn't yet ready to take over. This was Kindleberger's famous idea: Britain couldn't and America wouldn't. And so we need to, I think, in thinking about reform, we've got to ask the question, does a system to work well require a leading power? Because at the moment, if you ask who is the hegemon, it seems to me that there are probably two hegemons. There's certainly the United States, the decaying hegemon, but is China the rising hegemon? Maybe that doesn't really work for thinking about the future. Now, in the interwar years, the system broke down, and looking at that breakdown, Keynes, looking back on it, concluded that the main cause of British unemployment, with which he was mainly concerned, was the unbalanced creditor position of the United States, which was the main source of deflationary pressure in the world. Adjustment, Keynes wrote, was compulsory for the debtor and voluntary for the creditor. If the creditor doesn't choose to make or allow his share of adjustment, then he suffers no inconvenience. While a country's reserve can't fall below zero, there's no ceiling which sets an upper limit. So reserve accumulation by the United States he identified as the flaw in the system in the interwar years. And the same would be true, he argued, if private capital flows are the means of adjustment. The debtor must borrow. The creditor is under no obligation to lend. And his clearing union plan of 1941 was clearly designed to avoid a repetition of that situation, bringing the world down again into another Great Depression, insofar as international imbalances were the major cause of the Great Depression itself. And I think, obviously, they were a huge factor, apart from the mistaken policies of domestic policies of governments. And so, really, he argued that all residual international transactions were to be settled through clearing accounts held by member central banks at an international clearing bank. And I think I just emphasize the key feature of the Keynes scheme was that sanctions were to be applied against persistent creditors. They would be required to revalue their currencies, unblock any foreign-owned investments, and they would be charged rising rates of interest on credits running above their quotas. Any credit balance exceeding quotas at the end of the year were just to be confiscated. So they just lose their surpluses, and they'd be redistributed to the other members of the union. But having said that, and that was the focus of the scheme, Keynes did not believe in asymmetrical adjustment. He wanted symmetrical pressure to be applied on debtors. What he thought he was doing was redressing the balance in favor of the surplus countries under the old system and making them take their share, pay their share of adjustment. Well, we know that that system didn't work. The clearing union was never adopted. The Americans were never prepared to allow their hard-earned balances to be confiscated by a team of international managers. They wanted to control their own lending policies, essentially. And so you had the fund created in this building in July 1944, which was a fund. It didn't have nearly as many resources as the clearing union, and it didn't have the same function. In particular, it did not require surplus countries to, there were no penalties against reserve accumulation under the Bretton Woods system. So the main feature of the Keynes plan was not adopted. Well, it didn't work. It didn't work as the architects expected it to, because the United States became, the dollar became the key currency of the system. And as the system was set up, there was no provision for the dollar being the key currency. And the flaw in this new gold exchange standard system was pointed out by Professor Triffin of Yale University, which was that the increase in the liabilities of the key currency country was bound to raise doubts about its ability to redeem these liabilities in gold. So as long as the dollar was tied to gold, there was always a sort of discipline right at the end of the line. And when the French decided that they'd had enough of it, they were able to bring down the Bretton Woods system in 1971. Well, now we've got, we're into the new era. And what features of the original Keynes clearing union might be useful in the new reform program? Well, I think we need two requirements of reform. One is a smooth international adjustment. A requirement of a smooth international adjustment is a well-functioning mechanism for changing real exchange rates. We don't have that at the moment. And a second is that we need a reform of the current reserve system. We need somehow to lower the cost of self-insurance, which was one of the leading reasons for China to embark on its policy of reserve accumulation. We need to lower the cost of self-insurance, and I think we need, therefore, to internationalize the reserve function. And so we need more stable, we need a system whereby it's possible to change real exchange rates without producing a crisis. And we need an internationalization of the reserve function. People are starting to talk about these things, but we haven't got very far. Now, there's one, in order to achieve the second, which is not just to, in other words, to move over to an SDR system, if you like, you also have to have a substitution account. Because otherwise, you need some way of dealing with the liabilities, the accumulated dollar liabilities. And here, I just want to end on this point because I think it's a historical point. When they were negotiating the Bretton Woods system, when Harry White and Keynes were doing it, there was the problem of the British sterling balances, which were the debts Britain had accumulated from sterling area countries in the course of the Second World War. And they amounted to over £3 billion, $5 billion. They're large sums of money for those days. And Harry White suggested that they become liabilities of the new International Monetary Fund, so that they would be off the British balance sheet and onto the IMF balance sheet. Well, in fact, the dollar would be. Now, of course, Keynes turned it down, and the whole of the British government rejected it because they thought that would be the end of the sterling area. and that this was simply a ploy by the Americans to take over the role of sterling by showing that, you know, debts were not safe unless they were underwritten by the dollar, sterling debts. And it was a great mistake, because the sterling area sort of went on and on and on and wasn't finally wound up. These balances weren't finally, I think, got rid of until the mid-1970s in some way or other. But they were kept going, and the fact that the sterling area was kept going was a drag on Britain's economic performance right through the post-war period, because it meant the defense of sterling acquired absolute priority in British economic policy. So we're here now. I think this is where this is the reform agenda as I see it. And I wonder whether we'll need another crisis before we get to actual reform.
Thank you. Interesting. A lot of things there for us to talk about.